being participating in the CA Sri Lanka pre-scene discussion for last, I think, 4 years, I believe. So I'm very grateful for Charter Institute for inviting me to do this session. I'm happy to share my knowledge with you on this pre-scene analysis. I would appreciate if students also participate and ask questions because it's a pre-scene discussion. It's not the question and answer session in the sense like it's not a past paper. It's a pre-scene. This is your paper going to be. So definitely your 50 marks question is on this. So I'm sure you all have to go through your pre-scene at least a couple of times before your exam and do the basic analysis and get prepared what kind of questions going to be there so that you are almost ready when you're coming to the exam hall. Okay, so we come to a question or a case here. It's about a healthcare industry company, and the name shows that it's a listed company, Healthcare PLC. And if you read the background, when you are analyzing the case, generally we divide the case into four areas. One is the background, just to get an idea about what this company is all about and what kind of history it has and what kind of businesses they have been in business and how they have faced challenges and grown their companies. So those are, and the shareholding structure and how the management happens, all that is the background related. So I'm sure like if you're ready it once, you know it's about a healthcare company and which was started or founded in 2000, sorry, 1983, right? So 1983, they started. There are a few doctors who have got together and started this business. So you would see that the birth of healthcare PLC in page number two. Page number two, the last two paragraphs talks about how this was found. So 1983, Dr. Senaka Atukorala, along with three of his batchmates, Dr. Sanjay, Dr. Sunil, Dr. Vasanta, established a private hospital in Colombo called Healthcare Private Limited. So it was a private limited company when they formed in 83. Then they talk about those days it was a more of a government institution running the healthcare sector. So this is one of the institution which was started as a private institution, and they wanted to give a good quality healthcare system or the healthcare service at the affordable price with innovation. So these are the things they were more concerned about when they started. Then if you read further, you would see that this business had been very successful, or the customers or the public has taken it very positively, their business, and they have been getting enough customers, so they have been growing. So in 2020, so 2000, that is 83, they started in 2000, it's 17 years later, they listed their company. Colombo Stock Exchange, they listed the company. So when you are told about a company which is listed, few things should come to your mind. What is the purpose of listing generally? It's for capital raising. If you are planning for expansion, you need money, so you go for listing. So the one of the key thing when you go set the listed company, you know that you have enough opportunity to raise capital. That is the one important thing. Second, you have established your market value in the market. If it's a private company, you can do valuation, but then there is no readily available market value. But when you are a listed company, you have a readily available market value. So that is another important thing. When you are listed, your market value is established. Third, you start having a image in the market. Image you create. When you say you're a listed company, you are creating image. Fourth, anytime you want to diversify into your businesses and then you want to raise money, you not only share capital, you can raise money through debentures. So there are various other alternative instruments you could go to the market and raise money. So these are the some things which you should be aware when you are saying a listed company. So this company, this healthcare company, private limited company, also became a listed company in 2000. So we are talking about today context, 25 years back. 25 years back, the company got listed. So then you know that when you say you are listed company, you have shareholders. Then your shareholders could be your founding shareholders and your new shareholder who are the public shareholders. So it could be anybody, X, Y, Z, anybody can be a shareholder. So that we come to later when you are going through who are the shareholders of your company. Then if you take the pre-seen material, you would see that they have been doing many business in the sense in terms of healthcare. They have been trying to develop the business, but then when they look at the business growth, they have faced several challenges. Page number 3, if you want, right? You could see that page number 3, the company started facing some of the challenges. One important being the increase in operational cost. This is really relevant from financial angle. Operation cost has been increasing and pressure to expand services across the country. That means there has been demand in the market. So you realize that there could be opportunity to increase your branch so that you get more customers and more growth in your business. And third thing is the being competitive in the gradually liberalizing healthcare market. That means you are getting competition in the market. So you need to be developing uh, your strategies that could be bringing you to more competitive. So these are the challenges they were facing. With that, the governance reforms and strategic realignment. Now you may know that even though this is a pre-seen material for your final level paper, it has the pre-seen for 4 papers. It's not only financial management. It's for the auditing, it could be for the management. So you know that some of the area which you will be looking at in the pre-seen discussion could be relevant to not financial management area. It could be different papers, auditing or management or anything. So you may not really relevant to memorize all the things or understand everything, because there are some other things may be relevant to deep into it. I won't go through because that's relevant for another paper. So the governance reforms, strategic alliance, alignment, all that could be for your auditing paper, right? So it is actually now coming to key strategic lessons they have been talking about in page number 4. What are the strategic lessons they have got? So maybe not really relevant direct context to financial management, but then you could read it out, right? I'm taking because I want to take the FM areas specifically and discuss in detail, because there will be thousands of questions you can ask from me. So I can clarify those rather than just reading out the pages. Okay. So me moving on, they have started actually a company called Healthcare Laboratory Private Limited, page number 4, the last paragraph. So that is very important context, because being a hospital, you know that the laboratory services are very important. If you take any of the private hospitals in Sri Lanka, which are leading hospital, you will see their hospital and a laboratory. Laboratory is a business, even though sometimes your customers could be from other hospitals, but still the laboratory could be yours. So you may go to Durden's for your treatment, but your laboratory can be RCD, right? So the business, you can get multiple customers from different hospital business. So here they own Healthcare Laboratory Private Limited. They talk about fully equipped, internationally standardized laboratory and conducts wide range of diagnostic tests for both in-house and outpatient clients. So reliability and accuracy of the test of this company had been uh, popularized in the market. So there had been demand for your laboratory services, and they have got enough revenue generation from the laboratory business, and they are good network of collection centers. Very important is the collection centers located in suburban areas. They mentioned the Kandy Matra, Gaur, Gampa, Kagor, Kalatura, Panandura. For sample collection, only the 2 hospitals in Kandy and Mata reimburse for the actual collection cost. All other collection center only 10% paid as commission. So please understand this paragraph very important. Maybe at a later point, right? So make a note on that. It is in page number 4 regarding the laboratory services. because laboratory services, they are going to run on their own. Plus, they have the collection center that you would have seen in Sri Lanka. There are many places you get a collection. For example, Asari Collection Center, Durden's Collection Center, now local collection center. So people go and give their test sample. It could be a urine, it could be blood, it could be any other things where you want to test. You can give it to these centers. They will take it and basically send it to the hospital laboratory. Only thing is the collection centers have to be paid something. For that you are paying 10% commission as they mentioned. So this paragraph is important. Then we come to the growth of this business. Even though you are operating from Colombo, you have started two hospitals by acquiring two companies. So please understand page number 5. Page number 5, your first paragraph very clearly is mentioned. In keeping with the long-term commitment to make quality healthcare accessible across Sri Lanka, the HP undertook, that's healthcare, your company, major expansion initiative, expansion initiative in 2018, major expansion initiative in 2018 by acquiring 100% stake in two nursing homes, Kandy and Mathura. So basically, if you look at your timelines, 1983 you started your business, 2000 you listed your company, 2018 you are buying two nursing homes 100%. By doing it, you are going to own two companies. That company names are Healthcare Kandy Hospital Private Limited and Healthcare Mathura Hospital Private Limited. So two locations, Kandy and Mathura, you have bought two nursing homes 100%. So in your organization structure, you know now your listed company, that healthcare company, has two subsidiaries 100%, Kandy and Mathur. That names are also given. Third is the company which we already talked about. It's a laboratory company. So there are three companies which are subsidiary companies of your parent company. That is a listed company. So you know your structure at the moment. So the nursing homes, they have been converted into hospitals, Kandy and Mathura. So basically they are functioning as a private limited companies with limited resources. Actually, the limited resources and declining performance were the two homes, the nursing homes situation. And we bought it over because we know that we have established a name for the reliability and accuracy of the lab test and the hospital services. So we basically bought this institution and we are owning that under our umbrella of brand. Then moving on, by 2021, now 2018 we bought these hospitals. By 2021, you may mark these dates, right? 1983, 2000, 2018, 2021. 2021, both these facilities, the Kandy and Mathura facilities, had reached operational profitability and were receiving patient satisfaction ratings comparable to those of Colombo headquarters. Why I'm saying this? That means 2021 onwards, your two hospitals in Kandy and Mathura are operationally profitable. Okay, so they are not loss making, operationally profitable. That means before 2021, from 2018 to 2021, maybe 2 3 years, they have been not making operational profits. Now they started operational profitable company. Then we moving on to the page number 6. They have mentioned one important information. The company has not declared any dividend for 24-25. Can you mark that paragraph or make a note of it? That means the company has not declared any dividend for 24 and 25. It is a separate topic we will discuss later. That means your company has not paid dividend means whether it's good or bad. So we have to discuss that separately. Because there will be or there can be a question on this area because dividend policy they can ask you not paying dividend, what do you feel about it? What is your comment about it? They can ask a simple question. So you being a listed company, If you don't declare dividend, it's how it works. So we should discuss that. We'll keep it as separately. So for time being, please mark a note on that paragraph. Why they have not paid dividend? They are saying they are uh, reinvesting its earnings to support the growth initiative. The logic of their retaining the profits without paying dividend is to support the future growth of the business. So it looks good, but we'll discuss that later. Then we come to the next paragraph where they talk about the future growth of their profits. Now, this is definitely very relevant for your valuation area. Valuation area, you will definitely ask, you can be asked question, valuation area. But generally, the case study question of the past, I think more than 15 papers, if you look at it, out of a 50 marks case study question, 20 marks is for valuation. When I say valuation, valuation includes the valuation, merger, acquisition. So you are talking about out of 50 marks, your 20 marks is on that area. So that has a trend. If you look at the past paper properly, last 10 papers or 15 papers, you will see a trend of valuation, merger, acquisition area. That 20 marks question could have some information pattern, which is also here. That is how your earning before interest tax grow over the next 3 years. 2015, 16, 5%, 6% for 26/7, and 7% after that. So you are talking about first next year, that is the next year, 5% growth on your EBIT. Then 2 years, your growth will be 6%. After that, your growth will be 7%. How long? Infinite period. So this is the same kind of format you would see in the previous papers also. Not the number I am talking. The format means that your future profitability, how it grows. Because when you're going to do a valuation of your company, you need to know your future cash flows. So you start with the EBIT and convert that into cash flows. So in order to do that, you need to know the growth patterns. So they have given you the growth patterns. So if you try a couple of questions of the last 3-4 years or 2-3 years, you will definitely will understand what I'm talking. Okay. Then we coming to the next paragraph that where they say apart from the earning growth, the capital investment they are planning to make 80 million 2026. And working capital investment also they are given 20 million will be necessary throughout the 3-year period to support the expansion. So you are talking about 80 million capital investment, 20 million working capital. So this is also again free cash flow based valuation. If you are going to do, you would need this. Then they are talking about waste management area, that's being a medical institution. In order to maintain quality, you have to strengthen your waste management. So in 2017, they have understood the sustainability and patient safety. Basically, they are talking about waste management area, which they don't talk much about the numbers there, but they are talking about there is a must, right? So you could read that. Then they are talking about how they are going to do the upgrade to implement a decentralized waste management model for Mathura and Kandy Hospital. It's page number 7, talks about it. Then ERP system, that's IT system related, how they are benefiting from that. Page number 8. Page number 9, it's mainly onto the governance related. Again, I mentioned to you earlier, auditing paper would require you to understand that. So governance and leadership updates are given there, page number 9. Then we coming to the industry information, impact of the industry. So please note, this is something you may have to read it carefully, understand how the healthcare industry is currently in Sri Lanka. Right? The pressing issue they are talking, public and private sector, is the deteriorating quality and inconsistent availability of pharmaceutical product in the local market. So please note that that's the industry what has been faced, quality of the service and the pharmaceutical products availability in the market. So this is something a challenge for the industry altogether. Then the regulatory uncertainties faced in the market, foreign exchange limitation that affect your equipment imports and the drugs imports. And then there are increased competition from the low-cost clinics So that has basically low cost clinics basically will not provide you the same level of your quality like your private hospital, but they also provide some services to the market, so they can provide the service at a lower cost. That will affect your business competition point of view, and your profits also get eroded. If you want to really target that customer base and make business, then you are going to lose your profitability. Then patients affordability has also become a concern with the economic pressure, which you have to understand. Last couple of years, 2022 onwards, I would say, 22, 23, 24, maybe at the beginning, the country faced the economic crisis in the country. So they have to, the customers go through a major economic difficulties where they are not having sufficient money to go to a private hospital. So the private hospital going mean it's a pressure. So customers, you to keep the customers, you have a problem because you need to attract customers. Mean your prices have to be more competitive in the market. So that is also one of the challenges in the industry. We are still on the industry. Then your company's performance, being an industry player, you also face the same problem. Why? There is a competition. There is a less demand for your services because of the cost is higher, and cost escalation all disturbed your business. So when you disturb your business, your occupancy rates also comes down. Because in today's context, all of you all know that if you are getting into a private hospital for one day staying, how much it costs? Any idea? Anyone? If you are going to private hospital these days, how much you need per day minimum? Not a big treatments. Even just you say a fever, dengue fever, you are hospitalized and you are in private hospital. What will be the range? Anyone? No idea. Can anyone say how much roughly the cost? Roughly 80,000 to 100,000 rupees per day. Without that, you can't get into private hospital today, right? You can go to clinics, not to the hospitals. So that is the cost range. So if you are having an insurance policy, or if you are affordable to that values, you can go. Otherwise, you are in trouble. Better you go to government hospital. So that is something now you took it from HP point of view. HP is the company which is looking for customers. So customers will not come the way it used to be because of the economic issues and their affordability issues. So then your occupancy levels in the hospital, if you say 100 bedrooms, 100 rooms hospital, your problem with the people to come. So you have a difficulty. So that is something they also talk in the industry. When you don't get your numbers properly, the problem will be your profitability is going to be disturbed. So that's why there's a gradual deterioration in the financial performance of HP, which with particular stress on its regional hospital that are yet to achieve sustainable profitability. So regional hospital are not sustainable profitable level at the moment. Even though we were told 2021 onward they became operational profitable, now this paragraph says they are yet to achieve sustainable profitability. That means Kandy and Matra we are talking about, not the Colombo. Kandy and Matra, because of the overall impact of the economy issues and stuff, we are not getting enough business and your profitability is not very stable. Okay. So please make a note, not the Colombo one. Candy and Matra, your profitability is not stable. You are having some difficulties. Then the pharmaceutical. Now, this is the area definitely we have to be mastering because this is your acquisition or merger question area. They talk about potential merger. I think we are in page number what? Page number 10. Page number 10. according to page number 10, you will understand. Page number 10, can you all read the strategic direction on pharmaceutical integration? Then I'll Students, can you hear me? Can anyone say whether you can hear me? Yes, now can. Okay, thank you. Right. So then we coming to the Sun Lanka Pharma Private Limited, page number 10. I'm in page number 10. Sun Lanka Pharma Private Limited, if you look at, it's a target company which has been in pharmaceutical business with a reputable long-standing agency rights with the several European brands. And it's owned by Dr. Stanley De Silva, they mentioned. The company don't have a proper succession plan. So they have expressed interest in either merging the company with or selling to a credible healthcare entity. So that is the present opportunity anybody in the industry has. Why? You being a hospital, if you buy a pharmaceutical company, what kind of merger it is? Can anyone say? Can you say? Vertical. Please share the screen. It's not share screen shared. Can you all see? I believe that everyone has a tute with you, right? Share. Yeah, you don't have to talk. You can type, right? The messaging chat is working, right? Students, whether you can type. Yes, yes. Yeah. So we were talking about the pharma company. So it's available in the market to buy. Please understand that. And they have given you some information about the company. It has posted 252 million profit, sorry, 250 million revenue, 25 million profit, and margin of 10%. And the margin generally in this kind of pharmaceutical business is how much? How much the generally the margin in this business? Exactly, exactly. 30 to 40 percentage margin is in the industry. Generally, in this kind of pharmaceutical business can earn. But this SLP, that is Sun Lanka Pharma, is only making 10% margin. So that is something a problem in the company. That's why they are making lower margin. So we need to see why it has been making lower margin. But for a person who is going to have a integration or merger with this pharmacy, definitely will have benefit because he can manage it better. Because otherwise, the pharmacy is only a standalone pharmacy company. But being a hospital, you are definitely benefit because the pharmacy ready-made customers are your hospital, right? Your hospital, anybody who is coming as a channeling or a inpatient customer, both will definitely want to buy medicines. So you have pharmacy on your own, so that business will prosper. So that's a huge opportunity to buy a pharmacy company. So they have given you some information. Company has generated additional 8 million other income. Total operating net finance 7 million. These are just P&L items they are talking about. And finally, the company made a profit of 9 million rupees. Please see material sharing screen is not shared with us. Can you see that now? Now, okay, okay, right. So if you are looking at the page number 10, you would see that it has the Sri Lanka Pharma has made only 9 million net profit for the last year. Only 9 million net profit for the last year, which is smaller profit, which is smaller profit. But we know that that business has been not run properly because your margins have been 10%, whereas your industry pharmaceutical company could be generating 30 to 40% level, right? So in comparison, they have said the net profit margin 3.6. In comparison, industry players often report net margin between 18 to 15, 18 to 50. So the gross margin only we talked earlier, 30 to 40%, and whereas your company, that is Sun Lanka company, is only making 9% or 10%. So we know that the business at the moment is generating lower margin. So that itself opportunity because we have to find out why they are not making margin enough. Then we have to put our expertise and to increase our margin. So that's the opportunity we have got. Right? Then you can read the page 10 last paragraph. Company remain profitable. The margin indicate operational financial inefficiencies. So that is basically mentioned. Okay. Then going to page number 11. So we know there is a target company. We'll come to that discussion later. There is a target company, Sun Pharma, which is a pharmaceutical company available. As somebody mentioned, it's a vertical integration. Please understand what do you mean by vertical integration? In your supply chain, you are a hospital company. So you buying a pharmaceutical company is a in your vertical. If you are merging with another hospital, so for example, Dirt is merging with Asari Hospital, it's a horizontal merger, horizontal integration. If you are going to buy a pharmaceutical company, it's going to be a vertical integration. So you are, in case the examiner asks you what kind of merger is possible, it's a vertical integration in this case. Both mergers, you will have synergy. Don't worry that you will have synergy. Any kind of merger, you will have synergy because you are going to make use of the pharmaceutical business, because otherwise the pharmaceutical, if it is outsider, there is a margin kept by the pharmaceutical business. Now you merging that, definitely your margin can be improved. Why? In a sense, improved in a sense, you are going to get that profit also. So when you are going to use the pharmaceutical products in your own business, that is your hospital business, your margin is yours. Right? Please understand that. Then they are talking about page number 11. Financial controller of HP, MMRLE, advised the board that any investment opportunity, these are the important for your valuation question or merger acquisition question. It's again coming to the number game. Any investment opportunity should yield a net income return exceeding 17%. Average interest rate on the bank is the moment 8.5 to 10% pre-tax. Corporate tax 30%. Now, can you tell me the investment return you are expecting for any business opportunity is 17%, whereas your cost of borrowing is 8.2 to 10%, and that has a tax benefit of 30%. So, what is your cost of debt after tax? Anyone? I am going on the presumption that you have studied FM and you are looking at pricing. Not that you are learning FM in the pricing. Okay. So, what is the after tax cost of debt? Yeah, 9.7. Say, if you say interest bearing debt is 8.5 to 10% mean it's a range. It's a range. So if you want to take an average of it, it is 9.25. 9.25. So if it is average in 9.25, after tax rate is how much? 9.25, 1 minus tax. 30% you minus. How much is going to be? 9.25 into 70%. 9.25 into 70%, how much? Exactly. But I got many answers earlier. That is because you would have taken either 8.5 or 10%. But since they are given a range 8.5 to 10%, it's better that you take average of that. Because the cost of debt in the market could be in that range. So your rate is 8.5 to 10 mean average of that is 9.25. That into 1 minus tax. That's your cost of debt after tax. So that's going to be 6.5%. Somebody say 5.95. I don't know how you got 5.95. It's 6.5. Yeah, 6.5 is your cost of debt after tax. Why I'm emphasizing on this number, if you are going to borrow money and invest in any business, you can you can have a net cost of your funding is 6.5%. Then your return from your investment can't see. I have not done anything. I think the pre-seen material what you have should be there. Your pre-seen material must be with you. At final level students, the minimum thing you could do is having the material with you. Not doing anything, but just to have the material. If you don't have that, that's what I'm talking. Now, can you all see now? No. That means I think majority of students don't have the pre-sign with you. Very good. No, if you have the pre-scene, it's fine. Somebody saying the pre-scene I have. If you have the pre-scene with you, I am referring to pages also. No, so don't worry about it. So we go through that because it is can't see you or pre-scene. No, if you want to see me, I don't have a problem in showing my face, right? So can you take the page number 11? Page number 11. My simple question is whether all of you all have the pre-scene with you. If you have it, no problem. You just go through that page. I am referring to the page and explaining it. What is needed is the explanation, right? Yes, thank you. So if you take page number 11, we are talking about this cost of debt story. Cost of debt. Cost of debt is 6.5% as you all mentioned after tax. So what is your return you should expect in your business? But that is the key part of the financial management syllabus. 17%? Yeah, 17% is what they want. 17% what they are saying is their company, the financial controller, say that they want 17% return. That is their expectation. What I am asking is not that. I am asking if your cost of debt after tax is 6.5, if you are going to fund from the financing from debt, at least how much you should return? 10.5. I don't know from where 10.5 comes. Yeah. So I think you are 6.5. Yes, very good. I think most of the people are clear. Your cost of debt is 6.5 mean at least you if you're going to borrow and invest, you need at least 6.5. But being a company with the shareholders funds, your cost of capital is not 6.5. Your shareholder funds are also there. So that means you need to find out the cost of equity of the company, cost of debt of the company, and WACC of the company. So that WACC will be the information you will use it to evaluate your investment. But apart from that, how much this company want to return? Forget about their WACC, cost of equity, cost of debt. How much they would need? They mentioned that. Apart from their WACC calculation, you can calculate. Examiner could ask you to calculate WACC. So then you calculate cost of equity, cost of debt, and WACC. Very nicely, if you learn your cost of capital chapter properly, all the three information you can calculate easily without any problem. What I am asking is, apart from the calculation, how much they want return from the investment? Exactly. Their required rate of return they mentioned 17%. Right? They say that they yield a net income return of 17%. So that's about an income return. Actually, they don't say they generally the income return we don't call it. Right? It's basically the return on your investment we call it. So if you are looking at a 17% return on your investment, that is your real return requirement for your investment. It's not the cost of equity or cost of debt. It's actually your WACC. In this case, they are talking about 17% return. So just keep in mind, you have to be very clear about the return calculation here. Then they say company must prioritize investment project that generate return above 17%. So what they are saying is to ensure financial suitability, sustainability, and long-term growth, company must prioritize investment project that generate return above 17% benchmark. So they are want 17% return. It's not the 6.5 or whatever the cost of equity you're going to calculate. It's not about that. It is about 17% return. So when you're going to evaluate the pharmaceutical company for valuation or merger or acquisition, your cost of capital is going to be how much? 17%. Please understand that. Then they go on going down. They are given a forecasted 3 year forecast for the current business trend, SLP, that is your target company. They mentioned that. And they say that after 3 years, the company EBIT grow at a stable rate annually. Then they go and talk about the ownership structure. Page number 11, the ownership structure. So ownership structure and directors of healthcare, they are given the names. Can you tell me what is the percentage is with the founding shareholders? What is the percentage of shareholding with the founding shareholders? 23%? No. Who are the founding shareholders? This is a shareholding structure, very simple table. All the past papers have this. So that's why I said you try to do at least few papers, then you will definitely know this. Founding shareholder 65%. CEO is the founding shareholder. Exactly. CEO is the founding shareholder. And only 4 doctors were the founding shareholders. CEO came when? Can you look at the CEO when he got into the business? What is the period? When CEO came into business. I think when the company went for listing. When the company went for listing, 2000. Company started in 1983. I wanted at the beginning that mark the dates. 1983, when the company listed 2000. So 2000 only, the Prabhat Jayasinghe came into picture. So when I asked the question, who are the founding shareholders? Prabhat is part of the founding shareholder or not part of the founding shareholders? No, exactly. He is not. So what is the percentage of founding shareholders? 60%. Could you please repeat the WACC? Yeah. Now, what I meant is when you are going to talk about acquiring another company, always you use your present WACC of the company. When you say present WACC of company, you need to calculate cost of equity, cost of debt, and WACC. Then you use that to acquire a target company. You'd use it for discounting your cash flows. But in this case, apart from that calculation, you could do that calculation. The question has clearly mentioned, or the case has mentioned, companies required rate of return or the expected return is how much? 17%. So we basically understand at this moment, your return requirement is not the WACC, it is 17%. So when you're going to discount your future cash flows, you use how much? 17%. That is basically what I meant. Now coming back to the shareholding structure, you are very clear. Founding shareholder percentage is 60%, including the CEO. CEO, if you take 65%, then public shareholder, that's a multiple shareholder in the market, how much they own? 35%. Very good. So we are very clear now. The company is controlled by the founding shareholders who are 4 individuals who are doctors. They own 60% and their CEO own 5%, total 65%. So 35% in the public hands. And the company shareholding structure, we are very clear. Company's organization structure or the group structure, when you look at it, how many subsidiary company has? Very good. 3 companies. Two, somebody say two, 2 or 3? 3 companies. Candy Matra, 2 hospitals, 1 laboratory. 1 laboratory. 3 companies are your subsidiary companies. 2 subsidiary companies, Candy Matra 100% owned. Lab, we were not told very clearly, but I believe they also must be 100% company of yours. So basically three companies. So we know that there is your shareholding structure. We know the group structure. Then we come to page number 11, letter part, after the table of the shareholding structure. Share price of the company, listed company share price 52 rupees. Risk-free rate is treasury bill, treasury bond. We'll come to that. We have not come to that discussion still. Your market price is 52 rupees per share. How many shares company has? How many shares company has? I think you have been given the parent company balance sheet. How much is stated capital? I think page number for your support, you have a balance sheet of the parent company. Healthcare PLC, company group column, stated capital 3 billion. 3 billion. Assuming 10 rupees your nominal value per share, how many shares we have? 300 million. So 300 million we have. And 52 rupees is the per share value of the market. How much is your total market capitalization? 300 million into 52 rupees. How much is that? 15.6 billion. Your market capitalization, how do you calculate market capitalization? Number of shares multiplied by market price. Number of shares, assuming 10 rupees is the nominal value, 300 million shares, and 50 rupees, 52 rupees, it's 16 or 15.6 billion market capitalization. Please make a note somewhere, your market capitalization of the company, 15.6 billion. Now tell me, this market capitalization is the company market capitalization. Please tell where you get the number of shares. I think nobody has seen the pre-scene, right? I'm sorry to say this. Final level students, your balance sheet is given in the pre-scene. So balance sheet has stated capital 3 billion. And they don't mention the nominal value per share. I don't think they have mentioned nominal value share. But we assuming 10 rupee nominal value. So you are talking about how much? 300 million shares. So 300 million shares into 52 rupees market price, which is how much? 15.6 billion market capitalization. Please make a note somewhere. This company's market capitalization 15.6. My question is whether the market capitalization or market value 15.6 billion is the value of the parent company or parent company plus the subsidiary company. Is it a parent company value or parent company plus the subsidiary company? Parent company. Parent company, parent and subsidiary company, right? Both options are available for you? No. Always remember, in share market, the share price, please make a note properly. In share market, the share price reflect the value of the group. Value of the group. For example, if I say John Keel's holding share trading in the market, and if I go to buy the John Keel's holding shares in the market 100%, I will own not only John Keel's holding shares, not John Keel's holding value, I own John Keel's holding group. So your Ceylon Coal Stores, hotel industry company, Union Assurance, bank, Nation Trust Bank, everything comes with the package. So the price in the market reflect the group ownership, group value. It's not the parent company alone. Make a note properly. Those who made a wrong in your answering, please make a note. Share price in the market always reflect the value of the group, not the parent company alone. Okay, so that's very important. Because your answer will be totally wrong if you understood it's the value of the parent company alone. So 15.6 billion. That means if I want to buy the 3 hospitals and the laboratory, how much I have to pay the shareholders? If I want to buy the 3 hospital, that is Colombo Hospital and Kandy Matra Hospital and the laboratory, how much I have to pay? Very good. 15.6 billion. If I pay 15.6 billion, I get all 3 hospitals and the laboratory. I think excellent. Somebody mentioned minimum 15.6. I am with you. Right. We'll come to that discussion. We just want to know, understanding purposes, how much you pay, 15.6 to buy the entire thing. Why same value in company and group? I think that is your financial reporting paper, consolidation. Why the stated capital in company and the group the same? Because when you say the consolidation, understood the principle of consolidation. When you say you consolidate with your subsidiary company, the stated capital will remain the parent company stated capital. Subsidiary company stated capital will set off against the other side of the equity and the reserves. Right? So, in the sense like you will basically buy that company. Then it sets off. That's why the consolidation happens. That's your financial reporting area. Okay, so we're coming to the next one, treasury bills and bonds rates. Generally, please note, when you are going to buy a target company, we need to calculate cost of equity, cost of debt, and WACC if you are using WACC as the discounting rate. So, understanding and knowledge purposes, even though we know that this company have a required rate of return of 17%, still the examiner could ask you to calculate cost of equity using CAPM model. So if you are going to use the CAPM model to calculate cost of equity, you need to use the risk-free rate plus beta multiplied by again the market return minus risk-free rate. That's your formula CAPM. Risk-free rate, how much you take? Is it a treasury bill rate or treasury bond rate? Please make a note. If it is an investment, long-term valuation investment you're going to buy, it's always a risk-free rate will be your bond rate. It's not a risk-free of treasury bill. Why? You're talking about long-term investment or short-term investment. It's a long-term. So it has to be a treasury bond rate, you take it. Okay, so that's your principle. Whether 2 year, 3 year, 4 year, ideally you will take a longer period treasury bond rate. Longer period because long-term investment. So it's not a through 2 year business, it's going to be a longer term. So it should take a long-term treasury bond rate. Then they are given you a company called Global Pharma is a benchmark company, which is a proxy company or benchmark company. They have given you information. What is their beta? Company capital structure consider debt to equity ratio 30% with a beta of 0.4. Why this is given? If you want to convert the beta reflect what risk? Anyone? Beta reflect what risk? Yeah. Beta reflect the systematic risk, right? It has the operational and financial both, of course. So this systematic risk is 0.4 for the comparable company, Global Pharma. What is our beta? We have to convert from the zero point 0.4 equity beta of the Global Pharma. We have to convert that 0.4 to our company. Our company is healthcare. Our company, what is the gearing ratio? Anyone? That you have to see the balance sheet. You look at the healthcare company balance sheet. What is your gearing ratio? No one is answering. 2.26 group. First of all, group of your balance sheet, healthcare, are you equity based company or you are a geared company? Look at it. Look at the balance sheet. It is in the page number 13 and 14. Are you a geared company or ungeared company? Everyone, please look at the balance sheet. Spend few minutes since you're not seeing the pre-scene. Right? Now at least you see in your pre-scene balance sheet group. You look at a group. We always look at a group. Is it a geared company or ungeared company? What do you mean by gearing and ungearing? If your company assets have been financed by debt financing, you are a geared company. Whether it is 10% gearing or 20% or 70% or 80% is not a matter what I'm talking. Whether your company assets have been financed by debt financing. Yes or no? When we say debt financing, we don't talk about short-term period debt financing. We talk about long-term debt financing. Do you have long-term financing here or short-term financing? Remember, I think there is a large area in your financial management area that is capital structure. That is the serious understanding you should get. Your company, the healthcare company or the group, had been funded by the long-term debt financing or short-term debt financing. First of all, do your loans in your company. Balance sheet, you can look at your balance sheet. Do they have long-term loans? No, there are no long-term loans. What do they have? What do they have? They don't have long-term loans. They only bank overdraft, if at all the lease liability. Now, bank overdraft and lease liability is shown under current liability. The bank overdraft is 600 million and your lease liability is 100 million. Now, these two, now the question for you is whether your long-term debt or short-term debt. It's a capital structure theoretical area. If you're wherever you have learned this capital structure area, you should be saying in no minute. Within seconds, you should be answering this. Bank overdraft and lease is a long term or short term? It's a short term. But if your overdraft, again I repeat, if your overdraft or even though it's short term under current liability, if your company dependent on your overdraft to run your businesses, then that overdraft become not short term funding, long term funding. Maybe your company has borrowed say 10 million from the bank as an overdraft. But you cannot run your day-to-day business without run that 10 million. Even next year you need it. Year after you need it. Every day you need the overdraft 10 million. That means, are you depending on that overdraft? Yes. Then it is what? Short term or long term? Long term. Please understand that. If you are depending on that, it's a long term debt. But in this case, your company equity capital is how much? In this company or the group, what is the equity capital? Somebody saying 3 billion. 3 billion is stated capital. Equity, 13.6 billion. Exactly. 13.6 billion is your equity and your bank overdraft is how much? 600 million. Now tell me, are you dependent on overdraft? You get 100,000 per month salary and 100 rupees you have to pay for transport. Is it significant for you? No. Same thing. 13.6 billion equity capital company, 600 million overdraft. Are you depending on the overdraft? You are not. You are not. So therefore, whether your overdraft is a long-term funding for your company or short-term funding. Exactly, exactly. So you are very clear now. It's a short-term funding. Now tell me, your group is an equity company or a geared company. Exactly. So the global pharma, which is a geared company or equity company or ungeared company. When I say equity company, 100% dependent on equity. Global pharma is ungeared company or geared company? Global pharma. Geared. Very good. So, global pharma equity beta, are we given? Yes. So, can we know how to calculate from a geared beta to ungeared beta and the CAPM? Yes. So, do we need to calculate the healthcare company equity beta or healthcare company asset beta? First of all, healthcare company is a geared or ungeared? Ungeared. We are clear. That means do we need the equity beta or asset beta? Asset beta. So please understand from the proxy company geared beta, that is the equity beta, you calculate using CAPM formulas, you can calculate the ungeared beta or asset beta of healthcare company. So target for you is to use the CAPM formula. From the equity beta 0.4, you calculate the ungeared beta or asset beta. So generally, asset beta or equity beta, which is higher? Very good. Why? Why the equity beta is more than asset beta? Very good. Equity beta reflects the business risk and financial risk. Since asset beta reflect only the business risk, it is lower risk compared to equity beta. If your equity beta is 0.4, your asset beta will be lower than 0.4. So can you make a note somewhere? Whatever the number you are calculating using the formula, your asset beta will be less than 0.4. Okay. This is just for your understanding, for you to calculate cost of equity of the healthcare company. Cost of equity of the healthcare company. Because healthcare company, if you are using CAPM model, risk-free rate plus beta multiplied by market return minus risk-free rate. Okay, that's for your equity beta calculation. You will be, if at all they ask you a question, you can calculate. Then I go back to the, again, the page number 12. Now we have got some idea about that. Now coming to your financial information. Market return should be 17%. Not really, not really. In this case, they have not given the market return to you. I believe that in unseen material, they should be providing that. If they don't provide, you may use 17, but I don't recommend 17 because 17 is not the market return. What is 17%? Anybody? Can we use Global Pharma as benchmark company to Sri Lanka? I think that's a reason they are given. That's the reason they are given. That's the pharmaceutical industry, not the hospital industry, pharmaceutical industry. Actually, we were talking about healthcare company and the global pharma. I think more relevant global pharma would be to the Sri Lanka company, the pharmaceutical company. So Sri Lanka company, balance sheet also given, I believe. So when you look at the Sri Lanka capital structure, what is the capital structure? Sri Lanka pharma, if you are going to use the global pharma as a benchmark company for Sri Lanka pharma, what is the Sri Lanka pharma capital structure? It's a geared company, yes. So you can understand that Sri Lanka pharma is a geared company. So what we are do? If we are using the geared beta or equity beta, can you please repeat the asset beta, equity beta, that conversation? Yeah. Actually, the equity beta reflect business risk and financial risk. Asset beta reflect only the business risk. Global Pharma is a geared company. Therefore, the beta what is given 0.4 reflect business and finance. We just comparison purpose, we said take the healthcare company. Healthcare company is an ungeared company. So their beta will be only the asset beta, not the equity beta. But when you now come to the Sun Lanka Pharma, that's the target company for our acquisition. That company is a equity, sorry, it's a geared company. If it is a geared company, we have to use the equity beta of that company. So we need to find out what is the equity beta of Sun Lanka Pharma. Equity beta means business risk and finance risk both reflected in the equity beta. So we have to calculate what is the Sun Lanka Pharma equity beta. So I'm sure like you can identify what is the gearing of the Sun Lanka Pharma. Can anyone calculate Sun Lanka Pharma gearing ratio? Can anyone? How much equity? Equity is how much? Sun Lanka Pharma? 296. Very good. How much is the debt capital of the Sun Lanka Pharma? 122. Now, before calculating your percentage, please, I am going very step by step so that majority of the people will understand. Right? Equity 296. How much the debt capital of Sun Lanka Pharma? 123, 122. That is a term loan. You are adding the current and non-current liability of term loan. That is all. That's all you have. Not really. Now, I think few minutes before only we talked about this bank overdraft. If you have learned capital structure area properly, you will know this very clearly. Bank overdraft is not short term always. I told you that. Short term it will be if you are not depending on that. If you are depending on the overdraft, it is not a short term financing. It is a long term financing. For what you call healthcare company, overdraft is a short term or long term. That's our company or in the case, healthcare. Healthcare company, we had overdraft of 600 million. But we concluded it's a short term. Why? 13.6 billion company, 600 million is a short term or long term. You don't need overdraft. You have enough capital. Even if you want, you can settle tomorrow the overdraft. So you don't have a problem. Pre-seen for you to understand and analyze. Right? So you don't take everything to memory. Your understanding is important. Don't memorize anything. You need to understand the pre-seen properly. When you do it now, you have exam another few weeks, right? 2 weeks at least, 2 to 3 weeks. So you can do that calculation and everything, understand the case. Don't memorize anything. So there's a question about whether the lease of HP is a short term or long term. Now, HP company, how much your lease is? 100 million, right? So if you are 600 million, if you are not depending, 100 million, are you depending? You are not depending. So you don't have to worry much. Don't consider that as a long term, right? It's a materiality concept. You would have learned in auditing and everywhere materiality concept. 13.6 billion rupee company, 100 million is a big or small. No, there are no. You need to understand. Someone is asking about HP also in between, right? So I would answer for them. I am going the chat box and answering one by one and going, right? So the HP, it's don't worry about it. It's 100 equity company. Now coming to Sun Lanka. Sun Lanka, your gearing when I talk, is it long-term debt, term loan? It is another 1 million Current liability has 21 million. So both are your long-term component, 122 million. Plus 85 million bank overdraft that you have to add it. So 200 plus. Then you have a lease liability, which is how much? 20 odd million. So that also you add it because it's so long term when it comes to depend because you are not so comfortable with your equity. You are depending on the debt. So add all this, then you come your total debt capital. Total debt capital. Based on that, you tell me what is your gearing ratio. Overdraft, please consider. Term loan, please consider. Lease liability, please consider. 43.8%. 56 and 44. Okay. Please double check your number. 56 and 44. Everyone, please check. There are 78% also somebody saying. %78%. From where do you get 78%? Gearing ratio, how do you calculate? I think you have to go back to your notes and theories properly. Debt capital divided by debt plus equity is gearing ratio. Debt capital divided by debt plus equity is gearing ratio. So please tell me now. Debt, we defined debt in this question. Your term loan gearing is 56 or 44? Debt divided by debt plus equity. 46. 56. Debt is 40 or 44 or 56. I think 44 is the debt. 44 is the debt. Somebody is 41. I don't know how you all calculate. I have given the definition of the debt for this question. So based on that, 44, 56. So we know that the global pharma gearing ratio and our gearing ratio. So what we do is from the global pharma, we calculate the equity beta to asset beta. From the asset beta, again we calculate from Sun Pharma equity beta. So that is needed for us to use under CAPM model to calculate cost of equity to buy this company. Okay. I leave that for that purpose. Now coming to the balance sheet. Now coming to the balance sheet and P&L. So we come to P&L first. Income statement, company and group. Company has a profit of 555 million. Group has 2.3 billion. That means which is making more money? Can you tell me which company is making more money? HP. HP is making 555. Can you write it on a small note? HP make 555 million. Right. Then do we have any other company profitability? Page number 17. Page number 16. Page number 16. What is the company? Everyone, please look at the page number 15. P&L is given. Which company P&L? Candy. How much Candy profitability? 33 million. So you write down. First you write down healthcare, that's a parent company, which has 555 million. Then we have Candy, how much? 33 million. Then what else you are left with? What else we are left? Matra and lab. Exactly. Matra and lab. Very good. Intelligent. Now tell me, how much total group profit? How much total group profit? 2.3 billion. So you reduce the healthcare, the parent company profit and the candy profit from the total group profit. How much you get? Very good. 1.7 billion. Now 1.7 billion is contributed by what companies? So now tell me, out of the 1.7 billion, which is contributing big amount? Exactly. Somebody say Matra. I'm sure you're from Matra, but unfortunately it's not because Matra, I think they have mentioned, right? Somewhere we read it saying what? These two businesses are not having a stable profitability. They are not having stable profitability. And what is your laboratory income? Can you read the P&L of the parent company or the group? How much the lab revenue? 3 point something. Yes, 3 point something. So definitely you know that there is a big amount of laboratory income we are making. Okay, but we don't know the profitability of laboratory separately. So please note, make a note of that. Candy profit is given, parent company which is healthcare is given, Matra and lab not given, but we know the Matra also having not very good profit because it's a not sustainable profitability they have mentioned. So we don't know numbers. We don't know. Nobody knows number, but could be a small amount. So major portion comes from where? Laboratory. Laboratory revenue is how much? 3.1 billion. In laboratory business, you are collecting samples from the collection center, many collection center. How much you are paying for that? The collection center, many places you are collecting, how much you are paying? Only 10%. So you understand your cost of the collection is only 10%. But you have definitely other overheads. What are overheads? Laboratory means you have all the lab equipments. So you have a large amount of lab equipment depreciation, maintenance, laboratory. When you are running, you need to have nurses. They are the one who basically do the testing and everything. And then you have the X-ray machine and all that stuff. So you will have many of these things which will be a costly affair. We don't know the exact numbers, but definitely based on the group profitability, we can say that laboratory income is significant. Laboratory income is significant. We don't know much, but laboratory income must be significant out of your 1.7 billion. So keep that in mind. Now coming to your balance sheet, group and company balance sheet. Already gearing aspect we have looked at. So when you are looking at the ratio analysis area for this P&L and the balance sheet, you can look at your P&L ratios. Generally, we can calculate GB margin and net profit margin. We can calculate. I'm sure you can calculate. But only thing in this question, the ratio analysis basic need is what? Any of the ratio, if you are going to calculate for any company, what do you need? For you to make a meaningful comparison of the ratio, what do you need? You need comparative information. What are the possible comparative information you can have to make a meaningful information or analysis? Comparative information has to be given either for your industry, equity shareholder amount given, can we use it for market capitalization? What market capitalization? Which company we are talking about? Somebody is asking question not clear. Market capitalization of healthcare we already calculated. That is how much? 15.6 billion we calculated and done. So don't confuse again there. You don't need that is net asset value you can look at. Net asset value separately. 9.25 minus 7.5%, 2% as the market premium. What is 9.25? How much 9? Why, how do you get 9.25? Someone asked this 9.25 question. Can you answer? What is 9.25? Yeah, we skip. Right? Then we are talking about if you take the P&L of the company and a group, you can calculate the profitability ratios. That's the GP margin. You can calculate GP margin for company as well as group. I think I'm sorry that you need to learn the CAPM formula properly. The market premium is gap between market return minus risk-free return. 9.25% is your cost of debt. That is not market return. Market return is in share market. What is the average return on this period? That is not given in the question. So unseen material may give you. Okay, so let's leave it there. Now, what I was explaining here, if you are looking at the number of equity shareholders under P&L, where is that? Previously, we got nominal value 10 rupee, but under P&L, they have given number of equity shareholders. Where? That is not equity shareholders. Can you read that line properly? Attributable to page number 12. Page number 12. Attributable to equity holders of the company. How much? 2.3 billion. That is the same profit of the group. That is not the number of shareholders. Number of shareholders is not that. You are already reading only the equity holders. It's not equity holders. It's attributable to equity holders. That's the line. That means out of 2.3 billion profit, ordinary shareholders will get how much profits? That is 2.3 billion. This is actually the consolidated annual report. If you take any of the annual report in the market, you will see this line. So that's basically the profitability of the parent and group reflected there. It's not number of shareholders. Sorry. Right. Now we go to the profitability. I told you that you can calculate profitability ratio, GP margin, and a net profit margin. But the only thing what I was telling, even if you calculate this ratio, to make a meaningful comparison, what do you need? What do you need? To make a meaningful comparison, what do you need? You need comparative figures. Comparative figures has three choices you can have. One, industry. Second, last year information or previous year information. Third, budget. So please understand, to make a reasonable evaluation of the ratios, you need three information. One of the three, industry information, ratios, last year or previous year information, or the budget ratios. Without that, you can't make comparison. I can calculate GP margin in this question, but that GP margin, how do I say the GP margin is sufficient or not sufficient? Either I should be given industry or they should give the last year, something like that. We don't have such information. So even if you calculate ratio, you can calculate and keep, but there is no way that I can say that they have done better or not done better. Okay, please understand that. Next, balance sheet. Can you look at the balance sheet of healthcare? That's our company, group and company. They have invested in subsidiary company how much? How much they have invested in subsidiary company? Yeah, the unaudited financials are given. So generally, it's auditing mindset. If you look at it, that's a concern. But financial management, we don't care much about it unless the examiner later on says unaudited financial had manipulations or mistakes or something, then you have to correct it. Otherwise, we don't generally worry about this unaudited, right? So we can leave that. So we coming to the 1350 is what? Somebody saying 1350? I think I would have asked a question earlier. 1350. Investment subsidy. Thank you. Sorry about it. 1350 is the investment subsidy. So you have invested in subsidy. What are three subsidies? Candy Matra Lab. Candy Matra Lab. All three companies we have invested 1.3 billion. So examiner at this pre-scene level have not given how much we invested in Candy, how much we invested in Matra, how much we invested in Lab. Maybe in your unseen material, they may give you that information. Maybe you will be asked to evaluate whether investment was feasible or not feasible. Why? Candy, when you look at it, how much profit you are making? Small profit, right? And lab, you are making money. We understood lab is making money, but not the Candy and Matra. So maybe the examiner could give you information specifically to two of the hospital and say this is the amount you have mentioned, invested, but it is your profit you are making. Is it enough or not enough? They can ask you a question like that. So anyway, time being, we can't answer that, any of that. We know that they've invested 1.3 billion. Now tell me whether you are liquid enough. When you are doing a ratio analysis, we first want to find out whether your company or group in that manner, are you sufficiently liquid? Whether you have enough liquidity in your business. Can anyone say that? How do you calculate liquidity ratios? Current assets to current liability. Current asset to current liability. How many current assets you have? How much current asset you have? 7.8 billion group. Yes. Current liability. Current liability 2.1 billion. So are we having enough liquidity or not enough or not sufficient liquidity? I asked about current liability. Somebody has talked about non-current liability. Please check your numbers. So are you having sufficient liquidity or excessive liquidity? Excess liquidity. Very good. Very good. Actually, we don't say sufficient. We have excess liquidity. So excess liquidity, what is the problem? Excess liquidity, what is the problem? Very good. Low return. Profitability will be the problem. Right? So please note, since your company have excess liquidity, even though liquidity, you will not have any problem with the day-to-day commitments or any payments, but your returns will be lower. Why? You are excessively invested in your short-term investments and waiting. So it's basically will give you lower return. Okay, so please note that that is one of the key case where you are not going to earn enough return. Enough return. Then we come to the gearing. We already looked at the gearing. Healthcare group is it a geared company or ungeared company? Healthcare group is a geared or ungeared? We already discussed that. Exactly. It's almost ungeared company. It's almost ungeared company. Now tell me, if your business is profitable, geared company is beneficial or not beneficial? If you learn capital structure properly, you know the answer. If your company is profitable, gearing is good or bad? Yeah, exactly. Geared company beneficial if you are profitable. In other words, if your return from your investment is more than cost of debt, Gearing is good or bad? Like you are going to borrow money at how much rate you are talking about? We talked about earlier at the beginning. You are borrowing money from a bank or wherever. What is your net cost you are going to incur? 6.5. Excellent. 6.5%. You borrowed at 6.5 net of tax. Somebody say 9.5. That is all right. But that's a gross. This net is 6.5. If your investment in business generating 10%, good for the shareholder or not? It's good. It's good. So if your returns are more than cost of debt, always remember gearing is good or bad. If your investment return is more than cost of debt, gearing is good or bad? Very good. Very good. So in this case, tell me, you are a geared company or ungeared company? Ungeared company. Now tell me, you being an ungeared company and you are a profitable company, right? You are a profitable company. What is the return you are making? How much return you are making? 17%. I don't know where do you get 17? 2.3 billion is the profit. Very good. And how much is your investment in that case? You don't have debt capital, no. It's only shareholder funds. How much is shareholder funds? 3,000 is stated capital only. Please, those who are still thinking 3 billion is your shareholder funds, I think you are going to go back to your basics. Huh? 3 billion is share capital. It's not your equity. Equity is 13.6. That is your total shareholder funds. 13.6 billion you have shareholder funds, and for which how much your return you are making? 2 point something. So what is the percentage? Almost 17. Almost 17. 16.8 something. Almost 17. So that's the return you are making at the moment. Now, same company or the group, if they have borrowed money, same group, if they borrowed money, what would have been their cost of funding? 6.5%. If they have borrowed, say, 10% of their requirement of the capital, 10% of requirement of capital, they borrow debt capital and invest. That means they have borrowed at 6.5% and they earn how much return? How much return? 17%. The gap between 17 and 6.5, how much is that? 17 and 6.5 at the gap, 10 point something. That 10%, who gets it? Shareholders. Now tell me, this healthcare company, even though it's profitable, if they are geared company, will they be more profitable or less profitable? More profitable. Exactly. So if you are a company making money or profitable and your returns are more than cost of debt, you should use borrowing. At what level you borrow is your decision making. But you should borrow. If you don't borrow, are you making a sin or not? It's like you become a chartered accountant and then you work for a bookkeeping executive. Are you insulting the profession? Very much. Same thing here. After learning financial management, if you say your company profitable and you don't borrow any money and invest, where your returns are more than cost of debt, you are making sin. That means who is penalized? Who is penalized? Very good. Shareholders. What is the primary objective of the companies? Your first chapter in your syllabus. Very good. Wealth maximization. Whose wealth maximization you have to do? Government, banks, employees. Whose? Shareholders. So if you are able to earn more profits, more return for shareholders by borrowing money, will you do that or will not do that? You have to do it. If you don't do it, are you creating wealth or destroying wealth? Excellent. I think majority of the people, I'm very happy that generally we don't have this kind of knowledge to the final level when you do pre-scene. This kind of knowledge is not generally seen, but dispatch. I'm very happy that you all are. Most of the people, majority of the people are very clear about this area because this is the financial management. This is financial management. It's not about calculating numbers. Your understanding about these concepts very clear. Okay, so you're clear now. So this company could do better if they have borrowed money. They have not done, but if they do that, definitely they will create more wealth for shareholders. Okay, so that's very important knowledge. I'm sure definitely the examiner will have a question for that area. They should have a question for that area because that is your primary objective of companies. That's your first chapter. So they should ask with that question to say that whether this company is maximizing shareholder wealth or not maximizing. You don't say destroy, but you are not maximizing. Why? You have chartered account qualification and you go and work as accounts executive. So you are not creating wealth. You are not creating wealth. Okay. So that's very clear for us. So we have very clearly known that the healthcare group, can they make more money? Can they make more money? With your financial management expertise, would you tell them that you can make more money? Yes. What way? One, they can go for debt financing. What percentage you can suggest? 30%, 20%, 40%, all that. You don't have to go 80% gearing. 20%, 30% gearing is more than enough. This company will do better. Overall shareholder wealth will maximize. Your 15.6 billion market capitalization will easily touch 20 billion when you try to do little bit of gearing, 20, 30% gearing. That is one. Second, second, that's one is your capital structure, financial management knowledge has not been applied. If you apply that, you create more value. Second, by integration can earn money. I don't know what you mean by that. What do you mean by integration? Are you trying to say that Kandy Hospital and Matra Hospital to merge? There are two companies. They are one business, but you can't merge as such. It's for accounting purpose, you can amalgamate or whatever, but then two location you have to run the business. Hospital mean there should be doctors, nurses, equipment, premises, all the laboratory equipment, all have to be there in two different locations. You can't tell Candy man to come to Matra, Matra man to Candy. You can't do that. So that integration won't happen. So you know that one reason you can increase profit by borrowing money. That is one. Second important thing, are you making sufficient profit from Candy and Matara? Are you making sufficient from it? No, exactly. So it looks like you have invested in Candy and Matara, but still they are not stable, profitable companies. So we need to turn around those two companies to make more money. Otherwise, you'll be just having hospital, but you are not having money. You can say that I have hospital Gandhi, Matra, and founding shareholders, hometown, all that story nice, but then no money for the shareholders. Even though they are other shareholders, but there are public shareholders of 35%. So public shareholders are interested about their profits. And very importantly, what we talked once, but we will come to that topic separately. Dividend paid last 2 years, no dividend. So the dividend, no dividend. So if I am a 35% public shareholder, am I getting a return on this company? You being a 65% majority shareholder, you don't have worry. Why? It's your company, you can make return later. 10 years later also you can get a return. But I am a 35% shareholder who is willing to buy and sell shares. I don't get a return because you don't pay dividend. So I am happy or not happy? If the shareholders are not happy about the company, what happens? If the shareholders are not happy about the company, what happens? Shareholders sell the shares. Shareholders don't have a commitment to keep the shares in the company, no. No gratuity for them, no. So they will sell the shares. When they start selling the shares, what happens? Somebody is asking, how did you get 35% and 60%? Come on. We talked about that CEO and 5%. You put the CEO into the founding shareholder list. Public shareholding is how much? 35%. Price comes down. When the share price comes down, are you creating wealth for the shareholder or destroying wealth for the shareholder? When the share price comes down, are you creating or destroying? You are destroying. What is the primary objective of the shareholders or the company? Financial management is very, very, very interesting and nice subject. So please learn it properly. For a lifetime, it will be helpful. Lifetime, guaranteed. So if you have not understood that, anybody, please go through your theory classes, properly notes and videos and everything. Make sure you understand because it's a lifetime learning. This is not just for short period, not to exam getting through. Don't think like that. It's very interesting, and you are going to join a good company, listed company, a big company. You will understand this very much. Easily you will understand. Right? Gearing affected, started to sell the shares. This will increase the finance cost, sir. Yeah, finance cost impact will be there when you borrow money. But that you need to understand when your borrowing cost is 6.5% and you are earning 17% return, even though your 6.5 is P&L charge, how much you are making extra money? 17%. So the gap of 10.5, who is going to get? Shareholders. So shareholder want more money or no money? More money. Okay. So I think we are very clear on that area. So we have got the idea that this company profitability can be improved by borrowing money. One. Second, they are not generating enough return from the two of the hospitals they have invested. One is the Candy Hospital, other one is Martha Hospital. So they can do more profitable if they concentrate and focused on those two companies. Third, very important, very important. Have you used your, even whatever the money you have you invested your assets properly? No. How did you find out that? From where did you find out that they have not used their monies properly? Anyone? Asset turnover. No. We calculated liquidity ratio. When we calculated liquidity ratio, we found out what? They have money excessively. Where? In current assets, where? Financial assets. So they are not generating sufficient return or they are generating sufficient return. They are not generating sufficient return. Not generating. So can you improve the returns for the shareholders? Yes. So by improving, can you improve the profitability of the company? Can you improve the profitability? At the moment, you have invested in short-term investments. Can you invest in a long-term bonds? Can you invest in a long-term projects? Yes or no? You can. You can. So that is the third reason how you improve your profitability of the company. How you improve your profitability of the company. Okay. So I think those are some of the things. Even though you are profitable at the moment, from the group point of view, I have given you three important suggestions where your group can make more money. Okay. Now we come to the dividend policy decision. What is the dividend policy? Under theory, you would have learned dividend policy theory. There are residual theory. Then what? Anyone? What are theories? Dividend policies? Traditional view. There are theories. Relevant theory, irrelevance theory. Exactly. Very good. I think you all are very clear. There are three theories we talk about in the theory point of view. So this company follows what theory? At least last 2 years, we have been told they pay dividend or they don't pay dividend. Yeah, they have not paid dividend. So they have not paid dividend means they don't believe non-payment of dividend and the share price movement is there any relationship or no relationship? No relationship. They think no relationship. But you think relationship or no relationship. Very good. There is a relationship. So more you pay dividends mean share price goes up or comes down. What is the relation between dividends and share price? Your dividend growth model. Dividend price and shareholder price, dividend and shareholder price or market value. What is the relationship? Dividend valuation model, dividend growth model, positive. Very good. Inverse. I think you don't know the meaning of inverse, I believe. Positive. It's a positive relationship. Even a positive relationship, if you being a listed company, if you don't pay dividend for last 2 years, whatever reason you are so talking about, shareholders are going to take it as a positive thing or negative thing. It's like your company didn't pay bonus for 2 years. Positive impact or negative impact to employees? Positive impact. Which company? If the company don't pay bonus for the employees, not the shareholder, employees, that has a positive impact on the employees or not positive? Positive or negative? Negative impact. Exactly. Exactly. So can you think shareholder being a shareholder, I'm a 35% owner shareholder. I don't get dividend for last 2 years. I'm happy about it, not happy about it. Not happy. So that is a good thinking or bad thinking. Relevant theory says dividend and share price has a positive relationship. Relevance theory. Relevance theory says dividend, share price, positive relationship. So if you don't pay dividends, share price comes down. That means you are not maximizing shareholder wealth. You are destroying shareholder wealth. This is a theory question. Definitely they can ask you. 2 year dividend not paid. Comment about the dividend not payment and recommend what theory talks about it. Straight away theory question. So the dividend payment has to be made. Even though you might say that I am retaining profits for the growth of this company, it's not acceptable. Simple reason being, do you have excess money in the company or you don't have excess money? Are we having excess money in the company or not having excess money? Excess money. So do you still want to keep money in the company? No. I think we are clear, right? Don't go to the magnitude of these amounts and talk about it. Just get the principles of financial management clear. Then you are through. That's what the examiner wants. It's not about calculating the number and say 22%, 23%. I'm not talking about it. Financial management is a more of a conceptual area. Understand that, then you are definitely will be able to answer properly. Well, you clearly understand it. Right? I can see the majority of people are very clear about this area. So good that you have learned it properly. Right? So now, when you come to the other information in the paper or the precinct, last page, they are talking about the industry analysis information, Colombo Stock Exchange. Current industry PE, they say 13.3% healthcare industry is trading at, which is lower than 3-year average PE ratio 16.6. That means presently healthcare industry is trading at a lower PE ratio. Due to various reasons, the current healthcare industry is trading at a lower PE ratio. Then earning growth. Earning growth in healthcare industry have declined 9%, 9.6% over the last 3 years. However, revenue of this company have grown 9%. I think this should have been understood by you. Revenue was growing over the period of 3 years, but your earnings, that is profitability, have been dropping. What were the reasons? Can anyone suggest that? Revenue has been growing and the profits have been dropping. Healthcare industry. Why? Very good. High operating cost. Somebody say no, no, no. Why no, no, no? Healthcare industry profitability is growing. Not profitability. Revenue is growing, profitability is dropping. One is operation cost has been increasing. Second, we talked about 3 items, I think. Exchange rate fluctuation, yes. Somebody high staff cost. Those are you are saying about just your thinking and just writing. That's not the answer. This case doesn't talk about staff related cost, high finance cost. Come on. This is ungeared company. Where is your finance cost? Very, very small, small finance cost you have in your P&L. Don't just say that for just sake of these are the people who will have problem in the exam. You are just writing for sake of writing. Your finance cost in your P&L is how much? How much the finance cost of healthcare company? How much? I finance cost, somebody said no. How much the finance cost in your P&L? 68 million. How much your profit is? No, no, I think everyone is writing just the items without understanding the question properly. What I asked you is, I didn't ask what are item in your P&L. If I ask the question, what are item in the P&L, what your answer is correct. Admin cost, finance cost, those are the item in the P&L. That is a grade 7, grade 8 answer. I am talking to chartered accountant to be people. Please understand what I ask you is why the revenue increased by 9%, but profitability dropped by 9%. When the beginning of the case study, when we were reading, we said the profitability was having impact because of what? Higher operational cost. One. Second, increased competition from whom? Who are the people? You have enough time to read this case 3, 4 times, so you will definitely get the point clearly. But write it down on a piece of paper. Very good. Somebody read it. Low cost clinics. There are enough low cost clinics. They provide a service at a lower cost. If you are going to a private hospital, good private hospital for channeling, how much you have to pay? If you are going for a private good hospital today, 4,000, 5,000 rupees. How much is your nearby home, your clinics, if you are going to show the doctor your fever or throat infection or something, how much you have to pay? 1,000, 1,500. So, for healthcare PLC, this is the problem or no problem? Problem. That's exactly the question. So, please read the pre-scene and write down that cost, why that profitability was dropping. Right. Now, again, come back to page number 18. Page number 18. Industry PE forecast. Can you read that paragraph? Page number 18, last page. Industry PE forecast. Investors are more optimistic about health tech industry. Please note that word. It's not healthcare industry. Health tech industry, which is trading about 3-year average of 38.2. What is the health tech industry company we have in Sri Lanka in the share market? If anyone has idea about share market, health tech industry company, HEMA, HEMAS, HEMAS Hospital, yeah, HEMAS Hospital, hospital company. E-channeling, very good. E-channeling. E-channeling is a health tech industry company. HEMAS Hospital, Dividend Hospital, Navalok Hospital are hospital company. E-channeling is not a hospital company. What is that company? Health tech industry. That is trading at what P ratio? 38 point something. So that time, healthcare industry are two different industries. There is some relevance, some relationship, but that's not the same. So health tech industry trading at higher P ratio than the healthcare industry P ratio. Then investor more pessimistic about the healthcare service industry, which is trading at 16.4. That's the all the hospitals. Then healthcare of the future Sri Lankan pharmaceutical industry. Can you read that paragraph? So when you read that paragraph, the pharmaceutical industry is growing or expected to grow or not grow. Yeah, it looks it's going to grow, but if the growth rate is smaller or larger? Smaller, exactly. And please note, in Sri Lankan context, out of our pharmaceutical requirement, consumption point of view, we manufacture most of the pharmaceutical products or we import? We import. So please note, when you are talking about pharmaceutical business or even healthcare business, there's a considerable amount of imports involved. When you say imports involved, what risk we are faced with? Exchange rate risk. Even though examiner in the pre-scenes nowhere he mentioned too much about exchange rate risk, it is a exchange rate risk. The examiner could give you some details in your unseen material and ask you to basically do your calculation for exchange rate risk management. So the pharmaceutical industry is faced with that because most of your pharmaceutical products are not manufactured, imported. Okay, so please keep that in mind. So exchange rate risk management area could be a possibility. Okay, so when you looked at the overall picture of this case, we started giving the background and all that is fine. That's very study material. Out of 18 pages, 10 pages, you can talk about it. That they are not going to ask a question on that. Don't worry. They are not going to ask you when Dr. Senaga was born in when, which country, which hospital. No one is going to ask. So it is all just for you to understand the case. That's all. So when you look at the overall picture, this case, key areas for testing: one, valuation, merger, acquisition. That is definitely a question for you. So merger acquisition is the Sun company we talked about. Merger acquisition area. They can ask you to evaluate Sun company and value it. So when you're going to use the Sun company to value, please note Sun company net assets is how much? How many net assets of Sun company? Sun Pharma or Sun Lanka Pharma net assets is 296 million. So that is the target company net assets position. And we may use the cash flows forecast of Sun Lanka if they give. We can forecast the Sun Lanka company forecasted cash flow and discount and calculate the value of the company based on free cash flow model. So that is Sun Lanka company story. But if they are going to talk about valuation of the healthcare group, because I always say the case study question looks like this, the unseen material examiner can't go to another way of looking at it. He might now say a larger group in Sri Lanka who wants to diversify into different business is now eyeing to buy healthcare group. Right? You don't need to be talking about Sun Gamma Water company, smaller company. We are talking about we going and buying healthcare company, buying the Sun company. I am just giving you an idea. You don't need to be doing that. For example, say John Case Group. They want to get into healthcare business. So what they want to do? They want to buy the healthcare group. So the healthcare group, now you have to value. So in order to do the valuation of healthcare group, you have already two bases of valuation, already knows. How much healthcare group net assets? We have talked about the number many times. Healthcare group net assets how much? 13.6. Excellent. 13.6. That is net asset valuation. But we don't use the net asset valuation for any basis because that's the lowest value. Running company, profitable company, don't think of net assets. Just ignore. But you know that that is the minimum value. You get guaranteed value 13.6. How much is the market value of this company? How much is the market value of this company? 15.6 billion. Right. So you know that market value of the healthcare group is more than a net asset value. Okay. But is it the right value of the group? No, not at all. We ourselves identify three key reasons why the value of the group is lower. Why? Based on the pre-scene, already we have identified very good reasons why this profitability of the group 2.3 billion is lower. Why? Liquid assets. Exactly. No gearing. You are not used the capital structure area. Two hospitals are not making enough money. Two, third, excessive investment in your current assets. Excessive investment in current assets. So I repeat that for everybody benefit. One, you have not made use of capital structure theories. That means there is no chartered account in the company. Some EMMRLE or somebody is there, but she is not qualified, right? She has not gone to FM class, but she has got through, right? She won't know, understand financial management, right? If you know financial management, you should have made use of that money and invested or borrowed money and invested. That is one reason why your profitability is not enough. Maybe you are making money. I'm not saying you are not making money. 17% return, very good return. When the treasury bill rates are 8-9%, you making 17%, excellent return. But how much you can make money? 17 or more than 17? Very much more than 17. So that we have understood. Second thing we talked about, yeah. So you can forecast your cash flow. I think we have not finished that. Net asset valuation we know. Market capitalization we know. Third one, based on your forecasted cash flow, we can value the companies where they have given you a growth rate for 3 years and after that. So we can forecast the future cash flow for the healthcare group and calculate the market value based on free cash flow model. After that, as mentioned to you, any of the group in Sri Lanka or maybe elsewhere could buy the healthcare group from the doctors who have been running it for how many years? Donkey's years. From 83 years to 2025, 42 years. Now they must have very been old. They are very aged people now. So they want to retire from their business, right? So they might be wanting to sell their shares. So it's the right time for them to sell and good profits and good capital gain get out of the business. So new group buys the company. That's one possibility of area they can give you in the question. Please get ready for that. Not the Sun Gamma company, which is a smaller company. When you talk about your company size is how much? What is the revenue of your company? All three hospitals together, how much revenue you are making? Not the profit I'm talking. How much the revenue you are making? 16 billion. How much is Sun Gamma company making? It's a pharmaceutical company. How much revenue? 252. How much revenue? Sun Gamma revenue. How much you are making? 252 million. How much your group profitable revenue? 16 billion. Whether this acquisition is worthwhile, not worthwhile. Even though it's a pharmaceutical company, I agree. Is it significant or not significant? But they are talking about their potential license and all that stuff. I understand. But comparatively, if the examiner is really going to ask a question, merger acquisition area, what I was talking is some sensible question than this question where they're going to ask. So please be prepared from the group is going to buy the healthcare group. Okay. So your valuation going to be free cash flow model of the healthcare group. Okay. So that's one area, merger valuation acquisition. Second, cost of capital area. Cost of capital area, they can ask you to calculate cost of equity, cost of debt, WACC of the healthcare. They can ask you to calculate cost of equity, but cost of debt they can ask, they can, but then it doesn't matter because you are 100% equity finance company. So I don't think they will ask about that. But in case they ask, you can calculate. That is one. That third one, the important area is about the capital structure area. They can give you a theory-based question asking whether this company has managed the capital structure properly or not. Answer is no, not at all. Even though they are profitable, they are not using their debt financing option properly. So there your theory area can be tested. Fourth area is a dividend theory, where the company has not paid dividend for last 2 years. There is a share price, so relevance theory can be discussed, and you can recommend that they should pay dividends. Somebody was asking NPV analysis. I don't know. NPV analysis, this question don't have much about NPV. Maybe the question 1 and 2 they can ask. They have mentioned about capital investment 80 million. Do we divide into 3 years? What they are saying, 80 million they are going to invest. Through that 80 million they are going to invest. But when? No. They are very clear. To be undertaken in the end of year 31st March 2026. Page number 6. Page number 6, third paragraph, very clearly says the 80 million your investment 26. So very clear. Maybe the working capital they say it's you have to maintain. That again you mentioned investment in the first year, you maintain that. That means you don't add on the working capital. You don't add on the working capital. Yeah, the examiner can ask economic condition of the country and relate to the valuation. They can ask. Of course, if you are very good in economic understanding, that's good. Then you can answer that. Right? So we talked about valuation merger acquisition, then the dividend area, capital structure area. I think I am very much excited about the capital structure area because this question has enough room to talk about it. Then the dividend theory area we talked about. Then the ratio analysis they can ask. They can ask ratio analysis by giving the industry information or another company information and say whether the industry ratios are met or we are making money or we are losing money. We are following, complying with the ratios or we are doing better than the industry. They can ask that comparison. But it doesn't make much sense. But that can be. Okay. So I think generally 50 marks question is. So 20 marks easily you can be tested on the valuation area. They have enough information to get test on the valuation. When you take valuation, your return calculation, when you're going to do, they can use saying that please use cost of capital of the the company which is going to buy you. If they ask you from, say, John Keys Group is going to buy this company, they will give information about John Keys and ask you to calculate cost of equity and cost of debt of that company. Right? If they give different bond rates, how do we get the average? So I think I basically answer this question. Always is valuation or long-term investment is long-term. So you take the longer-term bond rate. That's more appropriate than taking average. Don't take 2-year bond rate, no point. It's a long-term investment, no? So you better take the long-term average, long-term bond rate. Okay, so the valuation area, CAPM model, the equity beta, asset beta, equity beta calculation, that is CAPM area. Then you are talking about dividend theory area. Then the debt capital structure area. Those are the 4 area, I think enough for this question. They can ask any question, but then the information given is relevant to mostly to those areas. Foreign exchange risk management also they can ask, even though nothing is in the pre-scene, but this company is exposed to foreign currency risk. So they can ask about it. Okay. So I believe that that gives you reasonable understanding. My simple recommendation for the people selecting the questions. Question 1, 2, 3. When getting EBIT, do we need to finance income? Actually, the finance income, if it is part of your operational income, yes, you take it. Finance income is part of your operational income, you take it. This company, you have excess financial assets. Excess financial assets. That's what you are getting the financial income. So you could take that because it's basically part of your business. If the unseen material don't give the market return, can we use 17% as a market return? True, you can because we don't have a choice then, but I believe they will give you. Operating leverage area, yes, they can ask. Now, please understand, any of the area can be tested, right? And especially the pre-scene, if you take the past 10 papers or 15 papers, you will see there are a couple of papers examine a pre-scene information hardly used in unseen. Pre-scene information hardly used. Even though you would have read the 18 pages for 5, 10 times and memorized some of the things, unseen material may not talk about it. Very, very few information. That's numbers they will take. But otherwise, they ignore the pre-scene. There are possibilities. So don't get upset about it. When you don't see that unseen, not talking about pre-scene, don't get upset. What I was trying to explain, question 1, 2, 3, 25, 25, 50. So how do you select the question? People are more thinking of 50 marks is best thing to take. Well, it's a big marks. No. Get the 25 marks. Why? 25 marks, 2 questions when you are doing, you are definitely getting 30, 40 marks. Because 25 marks is given for you to get marks. Will one director want to sell the shareholding? Can do that. It's a listed company, no. We don't have to worry about it. Anybody can sell the shares. He can sell in the market and get the money. It's not going to be listed. It's already listed. Very good. Somebody asked a very, very important question. If the calculation given that a group will going to acquire a healthcare, that I was explaining that another group, say John Keys is going to buy this company. Do we need to use the company figure or group figure? What is the answer? If anyone is going to buy this, unless they are going to buy only one company, unless they give you like that. But generally, everybody wants to buy the group. And you don't have a problem because anyway, it's a very good structure in this company. Why? You have 2 hospitals, Kandy and Mathur. Maybe some reason you are not still making money, but you have very good location, 2 hospitals. So make use of that opportunity to grow the business rather than isolate those 2 companies and buy the parent only. Don't be financial person alone. Think financial management person. The financial management is about you grow the company, grow the business, how to make the business out of the strategies what you can think of. Laboratory is making money, Don't ever think of leaving out the laboratory. You buy the laboratory. Okay. So question 1, 2, 3, always my recommendation was, I've been a lecturer for 20 years, right? Always my lecturing experience, I could tell you, please do question 1 and 2 and get the marks. You can get marks. Where there are 4, 5 parts in question 1 and 2. So definitely those are areas you would have learned already. So you can get 15 marks minimum. 15 marks minimum. If you don't get that mark, it's a problem. Then you have not learned anything. 15 marks is guaranteed. You can get. Then you move to the case study. Because the time management is important. Case study is a C. You go and jump into C. You don't get out. But question 1 and 2 is just swimming pool. You try that and you come out of the swimming pool and go to the sea. So even if you can't come, it's not a problem because you already got 30 marks. Then you have to be 20 marks here. So your answering has to be that. People think that 50 marks means we have to take 50 marks first. Then what happens is 2 hours you finish, you are still in the case study. Then you are under pressure to come out to the question 1 and 2. Then you have 1 and 2, 1 hour only. Even though that question you can get marks, you don't have time. But might as well use the 30 marks for question 1 and 2, or 30 marks, 50 percentage of time for question 1 and 2, and get the enough marks, 30 marks. 30 or more. I'm saying minimum 30. You can get that. If you reasonably done your work, you will get your marks. Please don't ignore any question. Very important. Right? Try much as possible. If you don't know anything, can't help it. But try to score marks in every part of the question. Due to the time pressure, most of the people, what they do is, first 3 parts they do, last 2 parts they don't read it. My experience, I can tell you, there are many questions in the past papers. Last part could be easier. Last part, you 4 marks, 5 marks, you can easily get 4 marks. The questions are very simple. But you don't have time because you don't see the question. At home only you read the question. So it's better that you try much as possible to answer every part of your question. Very important. Now you are waiting 2 weeks more or 3 weeks almost. These 3 weeks, make use of the time effectively. Try to focus if you have not done much work already. Try to at least do 5 papers minimum. I earlier say 10 papers, but if you have not done much, you don't have time, at least 5 papers. And be confident. When you're going to exam hall, you have to be confident. And very important that you maintain your positive momentum. I'm telling to people who have done this exam couple of times and failed the subject, generally you are demotivated. Though generally you believe that I have done enough work, but still I have not got through. So you don't have confidence to attempt the paper. But what I would say is forget about our negativity, concentrate on the positivity. Where each paper is a new paper. It's not the same paper repeated. New paper. And you have to see where you went wrong in the past and correct it. Sometimes the people who have failed generally have the habit of sitting on their own and do everything. If you have failed 1 or 2 times, please sit with another team of people, friends, 1 or 2 friends, not 10 people. 1 or 2 friends share knowledge and see where you have went wrong, why you are not passing. Right? So do the paper, share the paper among your friends and see whether your understanding and their understanding differ. These are smaller guideline I'm telling because there are a lot of people fail, not everybody pass. We wish that everyone on the pass, but it's not how it works. So its matter is that if you have doubtful area, you need to sit with your people, 1 or 2 friends, and make sure that your clarity is clear. Your clarity and that friend's clarity could be different. So please talk to each other and correct that. Most of the time, people don't want to share things. People think, no, I understood. You don't. You may not understand some of the areas. You memorize. That's a different story. Memorizing will not allow. But I think this batch, the present people who are participated today, I understood that majority of the people are clear about the theories. Wherever you learned your theories, it's good. You learn properly. So you're very clear. I'm very happy that your set of people I've done many times the pre-scene for Charter Institute. And in this batch, I think there are a lot of clarity in the people. So please concentrate on that and don't give up. Right? You have enough time, enough time. Make use of your time properly. Be positive. Talk to positive people next 2, 3 weeks. Don't be negative on anything. Right? Speak to good people who can motivate you. That's important because when you're going to exam hall, you make sure that you are getting through. Don't go with the negativity. Okay. So all the very best for your uh, exams. And generally, I could support to some extent, right? Because these are lengthy question I can't be explaining, but definitely I could support. So if you want to have small questions, you want to be clarified, you can WhatsApp my mobile number, not 772 857 326, not 772 857 326. So you could WhatsApp me. I am also working in a company, so I may help you when time permits. So at least I would do definitely before your exam. So I could support you. So all the very best, everyone. And thank you very much for Charter Institute for giving me this opportunity for many years. Right. So I'm very happy to share my knowledge. All the very best again. Thank you. Wish you happy new year all.